All right, welcome guys. So today's video will be about part one of the real estate case competition. This is the general due diligence. This is done every time in every company before a company invests in something. I know some of you guys have taken the investment security analysis classes. It would be basically identical to doing a fundamental analysis of any kind of stock or investment. It's a necessary first part. Um, so to get into it, here we see kind of just like an overview. So Fordham Investment Co., which is the name of our, fictional company, is looking to invest some capital in a new project located in New York City. Firm strategies to seek out and invest in apartment buildings with potential for retail space on the ground floor. This is a basic and simple understanding of how real estate private equity companies look, especially ones that deal with acquisitions. So to get started, um, here we go. So location overview. This is generally just, this is a broad explanation of the market that we are looking at. Manhattan, New York, just an island over 22 square miles, divided into various neighborhoods. This is where we're trying to look at. So we can just get started, location analysis. So in order to successfully analyze any kind of project, you have to have an understanding of the location that you're dealing with. Most of the time, this is as simple as just a Google Maps analysis. Just look up the property on Google Maps. So to get started, here we go. Here's the property on Google Maps right here. So right off the bat, we see Manhattan. This specific neighborhood is called Upper West Side. If you're familiar with the American Museum of Natural History, it's literally just across the street. Zoom in. So this kind of gives us a good understanding of the neighborhood it's in. Just by looking at this map, we see a couple of upscale. If you guys are like familiar with New York City, these are some upscale bakeries. This is an upscale restaurant. Um, Close to transportation. Here we go, close to transportation. Just make notes of this. In your, like you see here, I have a Google Doc or a Microsoft Word document open. Make notes of these things. Like this is an upscale neighborhood. So that would be, let's see right here, between West 77th and West 78th Street. Take a look at the street view. Very walkable area. Seems like there's a bunch of traffic right across from the museum. These are all important things to take note of when you do kind of like a Google Maps overview. The next thing is to take a look at market trends, pricing dynamics, see what the average rents are in the neighborhood. So on the left here, this is an example of a broker's offering memorandum. This is exactly what you'll get uh, from a broker. In our case, Tyler Senora, he's our junior advisory board member. Basically just sets up the building for prospective buyers, tells them kind of what's going on, things like that. So if you scroll down this way, you'll kind of get, and usually it's at the end, right here, statistics on the Upper West Side. So average rents increased in the Upper West Side. These are 2022 market reports, but it's, pretty much the same. It doesn't change that much year over year. And kind of gives you an outline of what the pricing and dynamics are in the neighborhood. Um, you'll see like examples of demographics here, household income brackets. 150K plus is the majority kind of like demographic in the area, so it is a high-end neighborhood, as well as the education. Additionally, on top of this, you guys should take a look at um, average rents in the neighborhood. So I just found this by looking up, let's see, average rents Upper West Side. rent hop right here. Average rents Upper West Side. Uh, 1 bedrooms, 2 bedrooms, price per square foot. November 2023 rent. This is the average rent. So take a note of this. This isn't as important. Clearly, you see rents have kind of gone down. Last year was a little bit crazy, but these are the current rents. So I would just take a note of that. Let's see. There we go. And that kind of gives you a graph. I mean, this is kind of important. You can kind of take a look at this, but not as important. These are the real figures that you guys should be looking at. On top of this, put in any other kind of information that you guys might think is important. Um, Basically, we want to have an understanding of what the market's like. Most of that can just be found by looking online. And then in addition, as to what we were doing before, the location analysis, make a note of these locations, transportation. New York City is very reliant on public transportation. Here we see it's close to the 1 train on Broadway, and then as well as, I'm pretty sure this is Columbus Avenue. Oh, that's not Columbus Avenue. Actually, I have no idea what this street is. But just take note of that as well. So the next step after location analysis, so just what I previously said, and then any other information that you guys might think is important would be to do a site analysis. Luckily, most of the things that we need for this are written in the OM. A lot of it can also be found on the internet through sites like Zola or other websites. I could also give you guys the links to that for access. But basically, you want to figure out the building, block, and lot. This is used for like tax reasons, and basically this like the think of this as a social security number of the property. On top of that, you want to figure out the square footage of the lot as well as the lot dimensions. If you're going to do a development analysis on a property like this one, this is important. It basically tells you like, what you can build on the ground floor and things like that. In addition to that, uh, these figures right here are very important. Um, so let's see. There are 56 units on the property, 2 commercial, and then 54 residential. Take note of that. Um, the total square footage, residential, 28,000 square feet. So this would be like kind of the square footage of everything above the commercial tenants. And then the net residential square footage, this is the sum of the square footage of all of the income generating units on the property. Take a note of this. Um, and then, yeah, that's basically what you have to do for a site analysis. Other than that, the rest of the site analysis is just kind of looking at the site. Is it in general disrepair? Does it look nice? Things like that. One thing that you could make a note of, and I was speaking to Greg Manicherian today, he was at our November 1st board meeting, is noticed how on the ground floor, so you take a look at this picture, this would be your retail tenants. These are, like this is a restaurant, I think. This is like some chocolate chip making store, whatever they are. If you were to do some kind of value add play or some kind of rehabilitation of the building, whatever you are to do, a good thing to keep in mind is when these tenants do eventually move out or their leases expire, as a property owner or landlord, you might want to come in here and get rid of all this stucco. Maybe put just like all glass or, something nicer. Right now, this doesn't look very attractive from the street level. So that's another thing you can make note of. Um, in addition, maybe resurfacing this brick facade or like repainting it. These are just things that, you know, you could make note of when looking at a site. On to zoning analysis. Um, basically, zoning is what the city and the board that comes up with these different rules allows you as a property owner, developer, private equity company, whatever, to do on that site. And it varies by neighborhood, it varies by, I guess, borough. Everything is different, right? So we're dealing with the Upper West Side here. Um, Normally, this information can be found in the OM. If you type in the block and lot on a website called Zola, you could figure this information out. But the broker gave us a pretty good idea of it right here. Zoning information, zoning. Oh, and I'll look this up. NYC zoning C1-8. Here we go. C1-8 zoning. That's not a good link. This is great. All right, right here. So basically, C1 zone properties are commercial districts, predominantly residential above, but they do allow for retail use. So this is your typical storefront on the sidewalk or street level with apartments on top. Many of you guys living on Arthur Avenue, those are all zoned C1. Yeah, so this is all that information. But like I said, most of this stuff is in here. It is allowed for a property to have a FAR of 7.52 in the specific district, which is, as you can see here, is the gross building area divided by the parcel size. Currently, there is only, let's see, 31,000 square feet of existing structure divided by the parcel size, which you can see up here, 8,000 square feet, 3.825. So clearly there's room to grow. If a developer was to say come in, knock down, and build like a taller structure, he is allowed to do that. Another thing that you could look at, which you can see right here, is that there's an additional almost 30,000 square feet of air rights available. Air rights is basically the portion, I guess you could say, of air above the existing property that you can build on. And it's capped at just under 30,000 square feet. So, say as a developer, I wanted to come in and I wanted to build, um, I don't know, probably an additional 6 floors above this this property right here. I have the ability to do that because I own those air rights. I can also sell them to the neighboring buildings. Say a developer was to come and buy those buildings, maybe these three right here. I could sell my 30,000 square feet of air rights to this developer. So there's options there. One thing that's very interesting is that when you do a analysis of this building, like right here, right? You wouldn't have much of an incentive to build higher because see how this building is on this corner? It's relatively thin. If I was to tear down this building and build an additional 3, 4 stories in residential units above, it would it would look something like this. And this is okay because it's in the middle of that block. But say in 5 years, this building just comes out, like comes on the market for sale. If I already tear down this building and decided to build on top of it, I just missed out on an excellent opportunity to have an even, larger building with even more air rights to build whatever I want on top of it, you could say. Um, on top of that, let's see, how do I get back to this view? I don't even know how to do that. Here we go. You know, if you take a look at it this way, you have our unit or our building right here and this building right here. if I was to tear this down and build higher, every building still needs to have this, 30-foot backyard in it. If I was to buy this building, I wouldn't have to have that. I could build, an additional, say, 3 units per floor right here. So, in this specific scenario, it doesn't really make a lot of sense for a developer to come in and develop this as a new construction building. And, this is all that you can figure out when analyzing the zoning information. So in this case, it seems like holding on to these air rights would be a good idea. Say this building was to go for sale. You could also sell it to this building. Maybe someone's gonna come develop right here where this Covacha Mexican is. And usually you can get, I don't know, say $100 a square foot times 30,000 square feet. You just made yourself $3 million. Um, And, that's just one of those New York City laws. But that's another thing to keep in mind when doing a zoning analysis. In addition to the previous like air rights thing I was talking about, you can just look this up as well. Air rights guide NYC. You literally just look up NYC air rights guide. Like that's about it. This gives you a good understanding of what are air rights. Um, right now they're say in between 100 and 300 per square foot, but that varies. In the Upper West Side, they're going to be very expensive. They'll probably be reaching 200 plus per square foot because of the neighborhood. Like most of the neighborhood is only as tall as this building that we're looking at, and most of the time that's because they already used up all their air rights. So if you're able to sell them to a neighboring property, that's very, you can make a lot of good money off that. Um, but yeah, this is just a good understanding of what that is. Not to mention, but is very important, is when you're analyzing the OM, right? Obviously take into account the purchase price, 37.5 million. In this market, this building can probably trade for 25 mil. Like realistically, whoever's selling this property is not getting $37.5 million for it. They're getting 25 for various reasons like rent control and rent stabilize. I will mention later in the video. But when we do get down to doing the analysis on Excel, this figure will probably go for 23 or 25. And then when you take a look at the financials of this property, right here, you see that the in-place cap rate is 4%. That is the cap rate that they are getting right now with these monthly rents. Cap rate is basically a return metric for, how fast or in what amount of time the property can capitalize on your investment. So it's 4%. And this is very low, especially in these days. A lot of properties will go for like 6%, 7. Some may be reaching 8, but when you look at the pro forma cap rate, 4.76. And the pro forma is basically, you know, pro forma means future, projected. It's a Latin word for something like that. And it's 4.76%. And that's based off these rents that they can achieve here. And just like you will see later in the video, the only reason these rents are higher is because you could do that with free market rents. You could trend them 3% around, give or take every single year. You can't do that with rent stabilized or rent control apartments. One major key thing that you guys might want to keep in mind is that when you do an analysis on something like this, you also have to take into account what the current interest rates are on properties, or real estate loans, commercial real estate loans, things like that. Now it's reaching about what the SOFR rate is, SOFR. I'll drop a link for that later, plus around 500 basis points, which is just 5%. If that is above what this cap rate is and even this cap rate, you actually have something called negative leverage, where the revenue that the property is making, your net income, will not be high enough to sustain your debt service, which is your annual amortization, which is your loan payback, plus the interest rate on that outstanding balance. That is something to take into account. So, say today's SOFR rate is, well, today's 10-year is 4.41, right? 4.41 plus 5%, that's a 9% interest rate. Off the bat, you already know this property cannot generate that, that kind of revenue. Based off the term sheet that we received, it's going to be SOFR plus 3%. If you look at this rent roll that I will send to you guys, forward curve interest rates, today's, you know, 5.33%. So it's going to be SOFR plus 3.5%. In the analysis, when we, eventually go through it on Excel, our cap rate will have to be above this number. It's doable. Some people will give you a construction loan based off the 10-year. So I'd be, say, equals 4.41 plus 3.5, 7.91%. Yeah, if we can get that property up to 8% cap rate, it's a doable thing. But that is something you need to keep in mind. And another thing to keep in mind is that this would most likely just be for the construction loan after, or not even construction loan. You're taking out a general loan. If you want to do like a value add, you'll take out an acquisition loan plus, like whatever you need for construction will be added into that. And that's usually in 3 years. So if you look 3 years from now, closing would be sometime around here. So 3 years from now, it'll be, say, around 3.6%. This is not exactly 3 years. Actually, take that back. It is. Plus, 3.5%. Yeah, if you refinance it in 3 years, which after construction and everything, you will, 7.17%. So 7% flat. That is doable. Based on what we can achieve by trending these rents in 3 years' time, plus whatever we can achieve from raising the rents and things like that. That's just something to keep in mind when you're doing an analysis. Now, as we get into multifamily and retail analysis, the first kind of thing you want to do is take a look at what already exists on the property. Like I said before, there was 56 units on the property, 2 commercial, 54 residential. As we're looking here through the rent roll, and this is just a sample, I have the most recent here with the most recent, dates. I'll put that into the email when I send this out to you guys. But just looking through here, we could see that there's a couple rent stabilized units. There's a couple free market units. This is what you think of when your normal apartments that you guys probably live in or may live in. And then we have one rent control apartment. And then here we are right here. So the difference between free market, rent stabilized, and rent control is free market. That's like your everyday apartment. You have a 1-year lease. At the end of the 1-year lease, your unit or your landlord can increase your rent. If it's a bad market, potentially decrease your rent. But if you don't sign to release the unit, you have to go. They have full control over everything in the apartment, how much they price it at, how long you can stay, things like that. Rent stabilized and rent control is very different. Rent stabilized is what you think of as your low income housing, right? You can't charge over a certain percentage, that like whatever low income bracket that you're in, you can't charge over a certain percentage of that. That's why you see the difference between this unit's monthly rent and this one's monthly rent is so high. In addition to that, you can't trend those rents. So with the free market unit, you can do an increase, like kind of the standard is 2 or 3% per year. You can increase the rent every time a new tenant, resigns, or you get a new tenant or existing tenant resigns the lease. You can increase that rent by 3%. Rent stabilized and rent controlled, you can't. As of 2019, these rents are going to stay at at this price forever, right? Rent control basically means the person living in that unit has been there since, I think it's prior to 1971. Could be mistaken, could be 1970 something else, but like those people have been in there for a long time. That's why they pay this price. But just like rent stabilized, you can't trend those rents up. Once their annual lease is done, you can't kick them out. They can stay in there, you know, until they die. And if they do, say die or whatever, um, you can't remarket that unit as a free market, apartment. You can't change that price. That price will be like that until they change the laws or do anything about it. It's a big problem these days after 2019 because a lot of people are losing money. They can't raise these rents. If someone decides to move out, it's not like they can, you know, make that into a free market unit. It's just like that forever now. Um, that's a really important thing to take note of when looking at this property. Here you kind of have like a setup, a stacking plan kind of shows that. Something you can do that's interesting, and if you look at this right here, is if you have two units side by side, for example, 1A and 1B, you can um, combine them if it makes sense and turn that into a new unit. And you can charge a free market rent. You can charge 3,600. The only thing with that is it'll still remain as a rent stabilized apartment, but at least you'll get some money out of it. So if you take a look at, let's say 1A and 1B, that's a perfect example because I think these are the only two units that are side by side that are rent stabilized. So yeah, 1A and 1B. Here we see 1006. Let's pull out the calculator. If you combine these two rents, or for example, 1A, right? That property will generate $12,000 a year in revenue. 1B will generate, about the same. If you combine those two units and one's a two bed, one's a two bed, one's a one bed, make like a 3 bedroom, 4 bedroom even you can do, and charge say 3,600 for that unit, you can make $43,000 a year just off that unit alone. That's another thing worth looking into. In this case, it only applies to these two units, but um, that would be something you can do. And so when you're dealing with multifamilies, this is a common thing. So now multifamily trends, basically everything that you guys might have looked at when doing a location analysis. You want to find what the overall market lease rates are and trends. You want to figure out what's driving these rents. In this specific case, Upper West Side is just a safer neighborhood than say, where I live in Hell's Kitchen. It's a lot less crazy. It's more quiet, things like that. And as a result, you'll probably see like an older crowd, but that older crowd can also pay the higher rents. Your demographics, like your local market, community interests. This is something that you can just like find online. Community interest in the Upper West Side might be, you know, families moving in, um, things like that. That's just something you want to keep in mind. And then when doing like retail trends, you should look up, what is the average rental rates per square foot. For this property, the average per square foot for both combined, it would be better to do it this way. 223 for the restaurant per square foot per year. That is high. That is actually really high for what this building is offering. And then, 144 per square foot per year for the smaller ones. Usually the smaller tenants pay higher square footage, um, or higher per square foot than the larger ones. But, take into account, try and look up and see what the neighborhood averages are. Retail is kind of like it's not really a big problem in the city these days. Um, but yeah, that would be another thing to look up. Definitely take a look at the outline. It gives you basically a good understanding of what you should be looking at. And then this video will probably give you a couple good examples of things that you guys should look at. Obviously, see if you guys can find some more information on the internet in terms of the retail analysis. That kind of information is a little bit harder to find. But I'll also drop this link in there you guys can take a look at. This basically gives a good overview of New Jersey, New York, Boston, but just look at the New York section. Um, and then in terms of the notes, this is an example of another property I did. Zoning, land use, purchase price, location. This is kind of like my notes right here. Um, Clearly, there could be more information. Um, but I'll leave that up to you guys. Try and look at different websites, try and find different kinds of information. Definitely take a look at the OM. Most of your information is probably going to come from here. But take a look at that, do it over break, do it whenever, send it back to me. If you guys could, you know, you guys could send it to me this way. If you want to put it into a PowerPoint presentation that looks nice, um, pretend as if and me and Eric speaking, pretend as we're a um, internal credit committee at Fordham Investment Co. And you're trying to get us to invest in this property and convince us that this would be a good property to invest in, as analysts as you guys are. Um, and yeah, we'll go from there. Then we'll also do the preliminary pencil test as well as the um, full modeling, but I think we should reserve that for next semester as that is very in depth. And I was talking to Greg Manicherian today, and he will definitely. I'll try and get us to go over to his office as well, see if he can explain it to us a little bit better. But let's save that for next semester. For this semester, let's just get this done right here. This part one. All right. Thank you guys for listening to me yap away for I don't even know 30 minutes. Um, I'll see you guys next time.